Welcome back. In Part 1, we explored the long-term plight of the US dollar and the resurgence of gold. Now, let's zoom out and focus on the present, deconstructing the specific logic driving this bull market in gold. In January of this year, at the beginning of 2025, when the gold price was still hovering around $2,700, an analysis article boldly predicted that 2025 would be the year gold would reach $3,000. Now, just halfway through, the gold price has already easily surpassed the $3,000 mark. This accurate prediction wasn't based on divination, but rather on a deep understanding of macroeconomic politics, central bank policies, and market sentiment. Today, we'll use this market-proven analytical framework to explore gold's next destination. Let's first return to the election at the end of 2024. Before the election, the market was filled with concerns about inflation, the economy, and geopolitics. This fear drove a large amount of capital into safe haven assets like gold, driving gold prices higher. However, after the election results were announced and the Trump administration took office, market sentiment took a 180-degree turn. Investors suddenly became optimistic, anticipating economic stimulus and deregulation from the new administration. They dumped defensive assets like gold and chased riskier growth stocks, leading to a significant pullback in gold prices at the beginning of the year. But, my friends, this is Mr. Market's favorite joke. This short-term, emotion-driven sell-off completely ignores the fundamentals that underpin gold's long-term value. It's as short-sighted as assuming the drought is over just because the clouds have temporarily cleared. One fundamental fact remains: after years of excessive inflation, the dollar's purchasing power has been severely eroded, and the price of gold has yet to fully reflect this depreciation. Thus, the pullback at the beginning of the year wasn't the end of the bull market, but rather provided those of us who were late to the game with an excellent opportunity to get on board. The market quickly calmed down, and gold prices found solid support on the charts. Over the past few months, they have stabilized and rebounded, gathering momentum for the next leg of the rally. The first key engine igniting this bull market is inflation. The latest core inflation data, such as June's 2.9%, while down from peaks in previous years, remains stubbornly above the Federal Reserve's 2% target. This sticky inflation suggests that price pressures haven't truly been lifted. The new administration's policies are adding new fuel to the fire: tariffs. Tariffs, by their very nature, are a tax that directly raises the price of imported goods, exacerbating inflationary pressure. Although the United States, Japan, and the European Union have agreed on a broad framework for a 15% tariff, going from near zero to 15% is still a significant leap. The Federal Reserve itself has acknowledged that tariffs are a significant factor in their upward revision of this year's inflation forecast. Thus, we face a situation where, on the one hand, untamed stock inflation is combined with incremental inflation driven by tariffs. Faced with these dual pressures, any rational investor will seek assets that can hedge against the risk of currency devaluation. Gold, in particular, is the most classic and effective weapon against inflation. Now, let's discuss the most crucial variable determining gold's short-term performance: the Federal Reserve's monetary policy. At the beginning of the year, widespread market concern was that the new administration's growth policies and tariffs would reignite inflation, forcing the Federal Reserve to adopt a more hawkish stance, meaning further interest rate hikes. Raising interest rates would increase the opportunity cost of holding non-interest-bearing assets like gold, thus acting as a significant bearish factor for gold prices. But reality has unfolded in quite the opposite direction. First, the prevailing view within the Fed is that current interest rates are already sufficiently tight, perhaps even too high, placing unnecessary pressure on the economy. They are more concerned about high interest rates leading to a recession than about reigniting inflation. Second, the pressure from the White House is real. There are even rumors of a shadow Fed chair, suggesting the government will resort to various means to pressure the Fed to maintain low interest rates in order to stimulate the stock market. The latest Federal Open Market Committee minutes and official statements confirm this trend. While they remain vocally vigilant about inflation, they have explicitly stated that 2 rate cuts before the end of the year are possible. The overall policy balance has quietly shifted from fighting inflation to preventing recession. What does this mean for gold? This means that the biggest cloud weighing on gold prices for 2 years, the interest rate hike cycle, has completely dissipated. In its place is the dawn of an impending rate cut cycle. When interest rates fall, and real interest rates, nominal interest rates minus inflation rates, decline or even turn negative, the appeal of holding gold explodes. In this environment, keeping money in the bank not only earns no interest but is also continually eroded by inflation. Gold, on the other hand, offers a solid safeguard for your purchasing power. Thus, we see that the bad news that the market feared at the beginning of the year not only failed to materialize, but instead became a significant good news. This is the core catalyst driving gold prices back up recently and poised to reach higher targets. Furthermore, the Trump administration's pressure on the Federal Reserve has had a significant side effect. It has exposed the world to the potential loss of the Fed's independence. This intervention has not only failed to reduce the U.S. government's interest payments by a single cent, but has also significantly weakened the dollar's credibility, driving more capital into assets denominated in other currencies or crypto assets. In this sense, Trump can be said to have lost the rice while stealing the chicken, but his undisguised intervention will redefine the dollar's independence, and there's virtually no going back. Okay, let's connect the dots and paint a picture of gold's future trajectory. Macroeconomic background: high political and economic uncertainty will persist. Issues such as trade policy and fiscal deficits are like lurking reefs, potentially triggering renewed risk aversion. Inflation: sticky inflation, combined with tariff inflation, will continue to erode the dollar's value, providing the strongest underlying support for gold. Federal Reserve policy direction: the Fed's policy focus has shifted toward easing. The clarity of interest rate cut expectations has cleared the biggest obstacle to gold's rise and provided the strongest fuel. Furthermore, from a technical perspective, after the pullback at the beginning of the year, gold prices have fully adjusted amidst the turbulent macroeconomic events of the past few months, establishing a solid base around $3,300 per ounce. The current technical picture shows a healthy upward trend, poised for a breakout above previous highs. Based on all of the above factors, we can draw a very clear conclusion: gold's bull market is far from over. The $3,000 target at the beginning of the year was merely the prelude to this grand symphony. So, where will gold's next stop be? Let's make a conservative prediction. Short-term target: over the next 6 months as market expectations for Fed rate cuts continue to build and materialize, there's a high probability that gold prices will continue to rise, testing and stabilizing at $3,500 per ounce. This price range is a reasonable technical extension and an initial response to current positive macroeconomic factors. Long-term target: 2026 and beyond. Once the rate cut cycle officially begins and the global economy inevitably falls into recession due to the lagged effects of high interest rates, we will see even greater capital flight from risky assets like stocks and an influx of gold. At that point, J.P. Morgan Chase's $4,000 per ounce target will no longer be a distant dream, but a completely achievable midterm goal. Friends, please remember that the core of investing is to see opportunities in times of panic and remain vigilant in times of optimism. The brief sell-off in gold at the beginning of the year was precisely such a panic window of opportunity. Now, when all logic clearly points in the same direction, all we need to do is maintain our faith and follow the trend. The foundations and momentum of this bull market in gold may be more solid than many of us imagine. The best is yet to come. Okay, that's all for now. We'll continue next time.